The recent news from the US government is significant. Proposed tariffs on European goods have been delayed. This is a welcome development for the markets. Markets absolutely detest uncertainty. Tariffs create enormous amounts of it. Therefore, putting these tariffs on hold acts as a positive signal. It permits businesses to catch their breath just for a moment. International trade disputes can rapidly unnerve investors. This delay provides a period of much-needed calm for everyone involved. The impact on overall market sentiment is quite noticeable. Consider this carefully. European goods, such as motor cars and luxury items, represent substantial economic sectors. A full-blown trade war in this area would be deeply damaging. The decision to delay suggests an ongoing willingness to negotiate. This is absolutely crucial for achieving long-term economic stability. Investors are now adjusting their calculations, factoring in a slightly lower risk premium. This frequently translates into potentially higher stock valuations. However, it is vital to remember, folks, a delay is not a cancellation. Vigilance remains the order of the day. So, what is the current outlook for the market? Cautiously optimistic seems to be the most fitting description. We are certainly not completely out of the woods yet. Inflationary pressures continue to lurk in the economic background. The policies enacted by central banks around the world remain a critical influencing factor. Nevertheless, this news about the tariff delay offers a genuinely welcome boost. It helps to establish a more positive and constructive tone. The market has been searching for a valid reason to rally. This development could very well be one of those reasons. Consequently, expectations for the stock market reopening post-Memorial Day are now leaning towards the positive. Traders will be returning from their extended weekend break. They will be carefully digesting this important tariff news. We could potentially witness an initial surge of buying activity. The well-known Santa Claus rally sometimes finds an early summer counterpart. This specific tariff delay might just serve as the necessary catalyst. But, as is always the case in investing, do not bet the entire farm on it. Diversification continues to be your most reliable friend. Booyah! Now, let us turn our attention to stock buybacks. US companies are projected to repurchase a record-breaking $1 trillion of their own stock. Yes, you heard that figure correctly, $1 trillion. This represents an absolutely staggering sum of money. When companies engage in buying their own shares, it effectively reduces the total number of shares outstanding in the market. This action can, in turn, make each of the remaining shares potentially more valuable. It is, in essence, a direct injection of significant demand into the stock market. This is a big deal, people. How precisely does this activity drive stock prices higher? It comes down to fundamental principles of supply and demand. Fewer shares available for purchase can exert upward pressure on prices. Stock buybacks also serve as a signal of confidence from company management. They are implicitly stating that they believe their own stock is currently undervalued. This can act as a magnet, attracting other investors to the stock. It is akin to a company placing a substantial bet on its own future success. And that, my friends, is an undeniably powerful message. We are observing this phenomenon across a multitude of different sectors. Looking at historical data, there is a demonstrably strong correlation. Cycles of increased buyback activity often coincide with broader market upswings. Alternatively, they can play a significant role in helping to sustain those upswings. Cast your mind back to previous bull market periods. Heightened levels of buyback activity were a consistently common feature. Companies that find themselves flush with cash often choose to return a portion of it to their shareholders through this particular method. For many investors, it is a more tax-efficient way to receive returns compared to dividends. This is not merely a coincidence, it is a recurring pattern. However, we must also consider a more nuanced, Shiller-esque perspective. Are these substantial buybacks always an unequivocal sign of underlying fundamental strength? Or can they, on occasion, serve to mask deeper, unresolved problems within a company? Companies might repurchase stock primarily to boost their earnings per share figures, even if their overall earnings are stagnant or declining. It is therefore absolutely crucial to delve deeper than the headlines. Do not just blindly follow the news of buybacks. Diligently analyze the company's complete financial health and prospects. Prudence, people, exercise prudence. Are you feeling the inherent heat of the market? Perhaps you are worried about managing investment risk effectively? There is an upcoming webinar focused on options trading. This educational program could prove to be a genuine game changer for many investors. Options are not exclusively reserved for high net worth individuals or professional traders. They can be remarkably powerful instruments for everyday retail investors too. Gaining a solid understanding of options can significantly aid you in managing your portfolio risk more effectively. It is all about adding more sophisticated tools to your personal financial toolkit. Knowledge truly is power in this complex game. One of the primary benefits of options lies in risk management. Options can be strategically employed to hedge your existing investment portfolio. For instance, purchasing put options can offer a degree of protection against a potential market downturn. This is somewhat analogous to purchasing insurance for your stock holdings. You pay a premium for this safeguard. Adopting such a strategy can effectively limit your potential losses. In markets characterized by high volatility, this sort of protection is incredibly valuable. It can genuinely help you to sleep much better at night, knowing you have a plan. The aforementioned webinar also aims to discuss enhancing your overall investment strategies. It is not solely about defensive maneuvers, it is also about offensive plays. Options can be utilized as a means of generating additional income. Strategies such as writing covered calls are particularly popular for this specific purpose. The webinar intends to demystify these often complex-sounding concepts. It promises to provide insights into methods that could potentially lead to winning 75% of trades. That is certainly a bold claim, so it is essential to learn all the pertinent details. But wait just a moment. Winning 75% of your trades does not automatically guarantee that you will become rich. The relative size of your winning trades versus your losing trades matters enormously. Options trading inherently involves leverage, which means that while profits can be amplified, risks can also be significantly magnified. This webinar should equip you with valuable knowledge. However, it is not a magical solution or a guaranteed path to riches. Always do your own thorough homework. Fully understand all the associated risks before you even consider diving in. No pain, no gain, or perhaps more accurately, know the pain to get the gain. Let us now attempt to analyze the current state of investor sentiment. It presents a mixed picture, which is often the case. Some market participants are decidedly bullish. They are cheered by the positive news of tariff delays and the ongoing support from stock buybacks. Others, however, maintain a more cautious stance. They cite persistent concerns about inflation and various global economic uncertainties. Popular gauges like the Fear and Greed Index might currently be hovering around a neutral reading. This typically indicates a market that is actively searching for a clear sense of direction. Behavioral economics teaches us that sentiment itself can sometimes act as a contrarian indicator. Extreme fear, for example, can signal a potential buying opportunity. What story are the technical indicators telling us at this juncture? Moving averages, the Relative Strength Index, RSI, and the MACD, the charts are indeed speaking. We might observe some crucial resistance levels being actively tested by the market indices. A decisive break above these established levels could potentially signal further upward movement. Conversely, a failure to breach these levels could imply that a pullback is more likely. Technical analysis is not by any means a crystal ball. However, it does provide a useful roadmap of potential future possibilities. It can assist in timing both market entries and exits with greater precision. Strategic planning is, without a doubt, of paramount importance. Do not allow yourself to merely react to the daily noise and churn of the market. It is essential to have a clear and well-defined investment strategy. What are your specific long-term financial goals? What is your individual tolerance for investment risk? The answers to these fundamental questions should consistently guide your decision-making process. Monitoring prevailing market trends is certainly important, yes, but you must endeavor to stick steadfastly to your established long-term plan. Do not let short-term market volatility derail your progress. This is a marathon, not a sprint. So, to concisely summarize the main points, tariff delays are generally good for market confidence. Stock buybacks continue to offer a significant level of underlying support. Options, when understood and used correctly, can be very useful tools for investors. However, the market, as always, remains an incredibly complex and dynamic environment. The overall outlook can be described as optimistic, yet a healthy degree of caution is always warranted. Keep learning continuously, ensure your portfolio remains well diversified, and always think strategically. The market will invariably have its characteristic ups and downs. Your ultimate success depends on navigating them wisely. Go, 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 but always remember to look carefully before you leap.